All right, let's dive into the Day 4 update for DEX Fees Bond Health. Today is December 10th, 2025. Now, at first glance, everything looks fantastic, but there's a hidden story here, and it's a really important lesson in DeFi about why you can't always trust the dollar value alone.
And of course, before we jump in, you know the drill. This is just for educational and informational purposes. It is absolutely not financial advice, so please always do your own research. Okay, let's get right into it. When you look at the headline numbers for day 4, it seems like a fantastic day. I mean, everything's in the green, and it really feels like it's all moving in the right direction.
First up, let's look at the bond price in good old US dollars. It's sitting pretty at $78.75. That's a solid 2.3% gain for the day, a very nice green candle.
And that growth is reflected in the total fund value too. It's up by over $36,000, bringing the total to more than $1.85 million. So you've got more money in the fund, a higher dollar value for the bonds. Everything looks great on the surface. But is that the whole story?
And this is where we get to the real meat of today's analysis. To really understand the bond's health, you have to look past the dollar signs and check its value denominated in ETH. This is the hidden story.
Okay, look at this. This slide tells you everything. While the USD price saw that nice green 2.3% gain, the bond's ETH ratio actually dropped by 3.27%. This is the crucial point. The actual amount of ETH backing each bond went down today. So that brings us to the million-dollar question. How is this even possible? How can two metrics for the exact same asset move in completely opposite directions? The answer, well, it lies in the performance of the underlying asset itself. And here's your answer. Ethereum itself had an absolutely monster day, pumping nearly 6%. When the main asset in the pool appreciates that quickly, it can create some very misleading effects on the surface. So here's how the math works out. That powerful 5.8% increase in ETH's price was more than enough to completely cancel out the 3.27% drop in the bond's ETH ratio. The result? That net positive gain of 2.3% in dollar terms. Essentially, the big ETH pump masked what was really happening under the hood. So what caused that ETH ratio to drop in the first place? Well, this brings us back to our favorite analogy, the seesaw. It's that constant battle between the trading fees coming in and the effects of impermanent loss. And on day 4, the seesaw tilted. The downward pressure from impermanent loss was simply stronger than the upward push from the fees collected by the liquidity pools. This happens when ETH's price moves way faster than the altcoins it's paired with in the liquidity pools. To maintain balance, the protocol has to sell a little bit of that appreciating ETH, which lowers the overall ETH ratio per bond. Today's impermanent loss was about 3.4%, which easily overcame the roughly 0.12% in fees generated. Now, let me be clear. This isn't a crisis. It's a completely normal part of how these concentrated liquidity positions work. Now, for the good news. The reason we're not sounding any alarms is because the fundamental health indicator for this fund, its volume engine, is still performing exceptionally well. It is absolutely roaring. Just look at these numbers. They are strong. Over 3 million in volume for the KTA pair, 2.7 million for LMTS, and 2.6 million for Zora. This strong volume means the fee generation side of our seesaw is still pushing hard. Fees are still accumulating. They just got outpaced by impermanent loss for a single day. And this is the key takeaway for the long term. Impermanent loss is often temporary. It can reverse if the altcoins catch up to ETH's move. But the fees generated during that time, those are permanent gains locked into the fund forever. Let's quickly run through the other key metrics to get a complete picture of the fund's health on day 4. Okay, let's look at the vitals. We saw 94 new bonds minted, which is a great sign of continued user confidence. The APR dipped slightly by 1.2% to 42.2%, but come on, that's still an incredibly strong yield. Finally, the fund maintains healthy liquid reserves of about $84,000, ready for operations and rebalancing. A quick check on where the assets are deployed shows no real change. The fund remains heavily concentrated on the base chain, with 89% of the total value locked. This is a strategic choice. You go where the volume is, and right now, that's on base. So let's put it all together. What's the final verdict for day 4? It's really a story of two different perspectives. The surface-level metrics like USD value and fund growth are green, but that crucial underlying metric, the ETH ratio, gets a yellow flag for today. The good news is that trading volume, the engine of the whole system, remains firmly in the green. So while it wasn't a perfect day, the vitals are still strong. So what are we watching for tomorrow? First, does the ETH ratio find its footing or continue to decline? Second, will we see altcoins rally to catch up with ETH, which could help reverse some of that impermanent loss? And finally, will that all-important trading volume stay robust?
So the battle continues tomorrow. Will impermanent loss keep winning, or will the fees fight back? Until then, stay informed and stay patient. Today was a perfect lesson in why you always need to look deeper than the dollar signs. And to close, a final reminder, DeFi protocols carry significant risks, including smart contract risk, impermanent loss, and market volatility. Please never invest more than you can afford to lose, and always do your own research. Thanks for tuning in.